Benchmark indices trade with sharp cuts as Trump imposes 25% tariff on India, along with an unspecified penalty over India's purchases of Russian weapons and energy. Pharma, IT, realty, all of them under pressure. The broader market underperforms.
Trump tariffs takes a toll on pharma, textiles, industrials, capital goods and EMS companies. Gokuldas, Apar Industries, Welspun Living, among others, trade lower.
Shares of HUL rebound from lows after reporting its June quarter numbers. It's the top Nifty gainer in an otherwise weak market. The company's profit rises 7% to over 2,700 crore rupees, beating street estimates.
HEG zooms in trade on the back of a steady set of numbers in Q1 FY26. The company's profits jumps multifold while margins expand year-on-year basis.
And shares of Jio Financial Services rise after the board approves raising funds of over 15,800 crore rupees through the issuance of 50 crore warrants. Hello and welcome to Chartbusters. We are coming to you live from the CNBC-TV18 Motilal Oswal studio. I'm Nigel, and today I have Vinny with me. Hey, Vinny, not such a bad outcome, right? If someone told you you're going to be down 170 points after hearing the tariffs are going to be at around 25%, I think the markets will take it. And what's encouraging, at least in the first hour, is we haven't seen those cuts deepen. So let's see whether or not the bulls have something in store. But I wouldn't really rule out a fight back because of positioning, because of underperformance getting into this event. So let's see how it goes.
Absolutely. We'll see how it goes. And earnings, that were reported by some of the companies are not that bad as well, right? We're talking about HEG. HUL. Good numbers in terms of volume, inline set of numbers. Then we have even those mid-cap, small-cap IT companies like Sagility. They're managing to do well. So we do have good numbers that are coming in. So in terms of earning front, I don't think there's a worry, at least on that front. So maybe, that fight back is something that we'll be watching out for. But, let's talk about the debutant on the D Street today. We have Brigade Hotel Ventures that are listed at a bit of a discount today of 10% to its issue price. Now, to discuss the way forward for the company, what are we expecting in terms from the growth strategy of the company? We have Nirupa Shankar, who's the managing director at Brigade Hotel Ventures, joining in with us. Nirupa, good morning. Thank you so much for joining in with us, and congratulations, firstly, on the listing coming in as well. Let's just start by talking about, now you can give us some numbers, you can give us those details as well. So in terms of numbers, what are we watching out for in terms of the growth outlook of the company, FY26, FY27? What are we watching out for there, and margins that we can expect from the company?
Good morning. Thank you so much for having me. It's definitely been an exciting day with the listing ceremony just over. In terms of our growth, what we've been saying is that, last year, of course, now that we're listed, number of forward-looking statements have to be limited. But what we are saying is that last year we saw pretty good growth in terms of revenue and EBITDA. We saw a 16 to 17% growth. And in terms of top line, and maybe another 15% in terms of EBITDA. And in the coming year, we feel that this year should not be any different. We feel very positive. I understand that the market is slightly volatile at the moment, and I feel that volatility is the nature of the game, and it is up to companies like us to keep our head down, work hard, and stand the course, and continue to deliver on good numbers.
Okay, continue to deliver on good numbers is what you're talking about. I just want to probe a bit more in terms of, given the pipeline that you have, 5 new hotels that are coming in, you have 1,000 keys coming in by FY28 to FY30. What is the peak revenue now that one could see coming in for the company? Overall, in terms of the business-wise, FY25, 468 crores was your revenue. Next 3 years, FY 3-4 years, what would we expect?
See, the next 3-4 years, we will have 3 hotels coming in by FY28. We'll have another 3 coming in FY29. And the business development doesn't stop just there. Every year we are doing business development continuously. In fact, apart from the 5 hotels where we've tied up the land and the brand, there are 3 more hotels where we've tied up the brand and the land, and that will be announced shortly. And in terms of the IPO proceeds, we have kept aside some funds to buy an unidentified asset. So it's more of an opportunistic buy. So there will be growth that we see over the next 3 years. Of course, with hotels, as you know, it does take time to develop. Greenfield assets can take, once you finalize the design and once you finalize the land and get the approvals, they do take at least 2.5, 3 years by the time they can open to the public. So it is a long-term game when it comes to hospitality. Peak revenues, like I said, by the time these hotels come up and start to stabilize, could be 5 years from now. But we will continue, our existing portfolio will continue to see growth. And like I said, we are looking for opportunistic buys in the market as well to spur on our growth.
Okay, all right. Hi, Nirupa. Good to see you, Vin. And you know, my favorite image when a company lists is the young ones coming in there to ring that bell. You know, what a joy, what a thrill. You know, someday they'll realize what a privilege it is as well. That said, wishing you all the best for this journey now that you're listed. But let's focus on geographical expansion.
Thank you so much.
Yeah.
Thank you so much.
Yes. You know, as of now, you have a stronghold in South India. How do you see geographic breakup move from here on?
See, our stronghold, even from the parent company, is the southern markets. We like the markets of Bangalore, Chennai, Hyderabad. Our hotels are currently in 5 cities. We will be expanding to at least 7 cities where we have current visibility and where we've acquired land. In the sense, expand from 5 to 7. Apart from that, one of the main reasons we did this IPO and sort of created our own entity for the hospitality vertical was so that we could look at markets where the parent entity doesn't already exist. So it could be some leisure destinations. Some of the leisure destinations we're looking at could be Goa or interesting leisure destinations in the southern markets within driving distance of the major tier 1 cities. Could be religious destinations where we can expect religious tourism to come through. So we are evaluating markets apart from southern India as well. But of course, a lot of the expansion will be in areas where we have a stronghold and where we understand the micro market specifically. And now I think the portfolio will move from mostly business-driven hotels to a very healthy mix of business and leisure. And the other change that you can expect to see is moving more towards 5-star deluxe hotels. We have signed up the Grand Hyatt in Chennai. It's a beachfront resort. We've signed up a Ritz-Carlton in Vaikom, Kerala. It's an island beachfront resort. We've also signed up the Intercontinental Hotel in Hyderabad. So these are all 5-star deluxe properties. So this will help increase the ARR of the portfolio when they come up. And this will move us into more of 5-star luxury deluxe category portfolio.
Okay, and just a quick one in terms of ARR, what would your guidance be for the ARR going forward?
See, ARR for the existing portfolio obviously is very different. But when, maybe when we look at the ARR for the existing portfolio, because these are mostly stabilized hotels, then typically you don't want to take a very high estimate. So our estimates are very conservative for the existing portfolio, could be in 9 to 10%. But when you look at the portfolio overall and where we expect the portfolio to be 4 to 5 years when the new hotels come up, will be a significant increase. It could even mean a doubling up of the ARR based on how these hotels open and what the market conditions are at that point in time. But like I said, we are moving to a lot more luxury hotels and we do expect a significant increase in the ARR.
Okay, Nirupa, thank you so much for joining us on the show today, giving us an insight in terms of what we should be expecting from the company. And good luck, and hope you join us more often now, given that you're a listed company. But with that, we are actually going to slip into a very short break. And post the break, we'll have the management of HEG joining in with us to talk to us about their quarter gone by.
Welcome back. Well, the markets are now at the high point of the day, actually. So we have cut our losses by close to around 60 to 70 points. The Nifty is now down 130 points. And the big boys, HUL and ITC, They are leading the way as we speak. And you have the Nifty Bank as well that's trying to stage a bit of a recovery. At some point of time, the intraday chart of the Nifty should come up for you on the screen. That said, let's focus on a couple of good earnings reactions. We have Manish Gulati, the Executive Director of HEG, who joins us on the show. Hi, Manish. Good morning. Good to see you win. And, after a few quarters, you have surprised very, very positively. Your shareholders will be very pleased to see what you've delivered. But overnight, the guy who's taken center stage is Mr. Trump. So let me get that out of the way first. They have imposed 25% on imports coming into the United States. Out of your total mix, how much of it goes to the United States? I think exports are 2/3, but out of that, how much goes to the United States?
Morning, Nigel. Good to speak to you. If you look at our total sales, it's just about 10-12% of our total sales. So yes, US is an important market, and yes, this is also what we are hearing last night news is all very fluid, and I'm sure it's still being negotiated like with other countries. So we will see how it proceeds in the future. But however, having said that, yes, we do treat US as an important market for us.
Okay. All right. But you don't see any big disruption is what you told us last time around. But we have got the number 10-12% of your total produce goes to the United States. For the past quarter, what was your utilization levels? And if it was at around 85% and I compare it with 80% in the previous quarter, that would mean realizations have improved by around 7-8%. Would that be a fair estimate?
Nigel, our capacity utilization for the last quarter was better than that. It was in excess of 90%. So that's where it is coming from. Pricing is a very slight increase because it's a basket. Some markets have some price increase. Some markets do not have price increase. So as a basket, it's very marginal, I would say. But volume is a big uptick from a level of 80% in the Q4 of last year to in excess of 90% in Q1. And as we speak in July, August, September, this quarter, we hope to be around 85%.
85%, got it. So let's get two factors out of the way. You said there was only a marginal increase in realizations, right? So for this quarter, what is the kind of increase we will see in realizations? Point number one. Have realizations bottomed out? So that's on the realization piece. And does this mean that Mr. Gulati and the team at HEG will now start reporting 20-25% margins for the coming quarters?
For this quarter, July, August, September, it's about going to be at the same level as Q1. This pricing takes time to stabilize. We are all looking forward to it, but it's maybe towards the later part of the year, we get actually you start seeing it in our profitability. So we are looking at 10%, some price increase, but not this quarter. So as we go, so that basket, it averages over time. So it takes some lag effect to see the price increase.
So then the price goes up by roughly around 10% in the second half of the year.
I hope so.
That's the hope. That's what you're pushing for. And the margin picture you were going to tell me?
The margin picture, you see, when you can look at our EBITDAs, like this quarter around 23%, but that of course includes some mark-to-market of Graphtech of about 23 crores. So these margins, I believe, towards the end of the year will come in that level.
So margins will continue to improve from here on?
Yes, margins should, stabilize and improve.
All right, so the worst of margins are in the price. Cool. If you could tell us, what about the industry inventory levels? What is it currently? How does it compare with averages?
The way we are working, we do not have much inventory in our plant, hardly a month or so. And in the system also, if we look at our customers, we don't see much inventories at places. So people are buying as they are consuming. So it's not an inventory overhang that it takes time. We're just waiting for the market to turn around and steel production to increase, which we are still not seeing. And it'll result in immediate demand for our product.
Okay. The encouraging part is you're sounding confident, so you're going ahead and you're setting yourself up for better times, increasing your capacity by 15%. Yes. Give us a few details. Will that be adequate needle coke? Because in the past, we know that for players like you, the needle coke availability has been an issue. So with this expansion, do you think needle coke will be on board? And what will be the mix? You've said internal accruals as well as debt. Split of it?
The capex is around 650 crores, and this money is going to be spent in 2.5 years. Mostly, it would be internal accruals, and we'll take some debt as we go by. And I mean, that's about it. And it takes 2.5 years from now. It's going to be at the same location as our current plant is, and we will be very quick to set it up faster than others because we have everything in place: the environment clearance, the utilities, the power connections, everything is there. So we'll be pretty fast with that. And why we are doing it, Nigel? Because we have been upbeat and we about the prospects of electric arc furnaces. We continue to track them closely, and we can see. The electric arc furnaces are coming everywhere in the world, not only in US, but in Europe, but in Middle East. Everywhere we see electric arc furnaces coming up. It's going to take a good 3 years for us, our production to be out. And it's just marginal. It's just 15,000 tons over 100,000 tons, which we just completed.
Okay, all right. Thanks a lot, Mr. Gulati, for joining in. Wishing you all the best, but you're sounding optimistic that things improve. For the time being, the street likes what you've delivered in the past quarter itself. By the way, before we wrap up, pull up Tata Motors. Sudarshan told us earlier this morning that he believes that bulk of the bad news is in the price and the deal actually could be favorable post the recent correction. The stock now at the high point of the day. Well, we'll wrap up on this edition of Chartbusters. Stay tuned. Trading Hour comes up next.